Welcome to my end of the year 2018 housing in review. I'm going to try something and let's just see if it works.
Now take a look
it does.
At
Here we go.
Past, present, and future perspective.
This is an interview I just did.
Kathy Fettke, the co-founder and co-CEO of the Real Worth Network. Kathy, thank you for being with us.
He said the company name wrong.
Appreciate it.
Thank you.
So let's start with looking at where housing has been this year. It's been sort of a wild ride. And bring us up to date, not this week, but just before this week. Let's go back and take a look. What's happened?
Well, this could be the year, 2018, that would be described as conflicting agendas. And what I mean by that is we have a Trump administration that's stimulating the economy, and we have the Federal Reserve raising rates to slow things down. We have the Trump administration trying to create jobs, but we have low unemployment and a surplus of job openings, at least in the construction industry. So what does this all mean, and how has it affected housing? There were so many questions at the beginning of the year. How would the tax cuts affect the housing market? And the way it seems to have sifted out is that it's very, very good if you are an investor. There are incredible tax breaks. However, many homeowners, if you're buying your primary residence, it's not as good. Certainly not in the higher priced markets. The tax deductions were cut, and along with interest rates rising, we're seeing a slowdown now just over the last 3 months in the housing market nationwide.
Well, I want to talk about something you just touched on there briefly, and that's the higher-end markets. So we move sort of from the past to the present. And high-end home builder Toll Brothers is out, and they've reported a deep dip of 13% in new home orders in their fiscal year fourth quarter. There's been decreased demand in general in housing, as you were talking about, but these new numbers show even more high-end home building will slow. I mean, what do you make of the high-end stuff in particular? Is it just because of those tax disincentives you're talking about?
Well, I want to go back to what you said and say it's not that the demand isn't there. The demand is certainly there, and who wouldn't want to live in a nice home or a luxury home? It's the ability and the marketplace for that. One of the big things that we've seen this year is a pullback from Chinese buyers. The Chinese government is really discouraging investment in U.S. property, or really outside China in general. So with that pullback, we know that Chinese buyers really liked high-end properties. So they're, for the most part, out. So who's there buying in their place? We've seen prices go up because material costs have gone up, labor costs have gone up because there's a low supply of workers. We have the tariffs increasing materials, interest rates going up. So it is getting harder and harder for the average American to buy a new home. And that's why we are seeing a slowdown. Also, in the multifamily sector, there was an oversupply of multifamily built in Dallas, Seattle. We're starting to see rents decrease, and so again, we'll see a slowdown in building multifamily in the big metro areas.
And why are we seeing sort of the slowdown overall? I mean, is it interest rates? We're probably going to have another one coming up next week, the slowing economy, or what? And by the way, didn't this happen with the taper tantrum back in 2013?
Yeah, it's amazing how many people don't understand that when the Fed is raising rates, there's one reason for that, and it's to slow the economy down. And the Federal Reserve usually gets what it wants. It's been raising rates consistently, probably will do it again next month, and that is, in my opinion, the very reason that we've seen housing slow down. However, it's important to remember that home prices are still increasing. They're still up 5-6% from last year. It's just slowing down in the pace of sales and in the pace of increases. We're not in any kind of recessionary situation in the housing market, and I have no fear really of that happening, because people who have bought homes in the last 10 years, they had to qualify for those loans, they had to put down payments, and they had low interest rates, and they have equity because home prices have gone up. So I don't see anybody walking away from their homes, but we just might not see the price gains and the quick pace of sales that we saw over the last decade.
Well, I'm going to take that as your prognosis for the future, Kathy. Hopeful and optimistic with some data to back it up. Kathy Fettke of the Real Wealth Network. Thanks, Kathy. Happy holidays to you.
Thank you.
All right, so that worked. I just wanted to share that because this is my year-end webinar, and that was an interview I did last week that summed up some of the things that are going on. But what I wanted to do on today's webinar is just hold myself accountable for some of the things that I predicted last January at our event, and what the reality is now. It's not the end of the year yet. We don't have final numbers, but we have a pretty good idea. So let's see if I was even close to being right. So last year, I did believe that with the tax cuts and with just the overall animal spirits of positivity and a booming economy, that we would see President Trump hit his goal of a 3% GDP. And sure enough, this is what the year looked like. It was a little low starting off, but then July was a big month. A lot of people say that's when the tax cuts really kicked in. And so when you average it out, it will be right around there. We don't know for sure, but it looks like I was pretty close on that. And then Fed hikes, my prediction, actually this is where I did not hit the mark, because I really didn't think that the Fed would be in a big hurry to raise rates due to the fact that there's so much debt. And the more that the Fed raises rates, the more difficult it is to pay that debt back, whether it's corporate or personal or national. So I was wrong, because they just raised rates again. The Fed hiked 4 times in 2018. So I was off there, and that just basically summarizes what I said in the interview earlier, that when the Fed is raising rates, there's one reason for that, and one reason alone, and it is to slow things down, to slow down inflation. And when I said in the interview that this is the year of conflicting agendas, what I mean by that is President Trump's entire campaign is about creating jobs, and yet we have a surplus of jobs right now. In fact, there was an article that came out saying we may have more jobs than we have people looking for jobs. So, you've got a government president that is trying to stimulate the economy at the tail end, at kind of at the peak, still trying to stimulate it, because no president wants a recession on their dime, right? So he's really been active in stimulating, and while the Fed is trying to do the opposite and tightening. So you've got two very conflicting agendas, and where that will end up, I don't know, but we all know in the headline news that the president is not happy with these rate hikes, and had a word with with the Federal Reserve to say don't do it, and they did. So the stock market was affected by that, again, conflicting message. So the bottom line is that we do see a bit of inflation. It's the Fed's target, where they would raise rates at the 2% target, and we do have too many jobs. When you have too many jobs, what that does is creates more inflation, which is what the Fed is trying to prevent. Because when you're an employer and you have a job opening and there's nobody out there to take the job because there's so much competition for jobs, you have to raise your pay, your wages. And while that's great for the employee, it isn't so great for the company's bottom line or for inflation, because let's face it, the company's not going to take the hit. They're going to pass it on to the consumer. So whenever job unemployment gets this low and employment this hot, then the Fed will raise rates to slow things down. So we'll talk about again what that means for real estate at the end. Mortgage rates. I predicted that rates would hover around 5% and then reverse, because for the same reason I said earlier, we have so much debt because interest rates were low for so many years, nearly a decade, at almost zero, that corporations could borrow for so cheap, and so could people with credit cards. And of course, it was really meant, all the bond buying program of the Fed was meant to keep mortgage rates low to stimulate the housing economy. And all of that worked, and the economy is booming as a result of all this debt. But, that debt has to be paid back. And when you raise the interest rate, you know what that's like when you have a credit card and you get it at 0%, and then you buy a bunch of stuff, and then the next thing you know, you look at it, it's 28%, and it's not fun anymore, because now you got to pay for the stuff that now you already have and you don't really want anymore, because you got to make these payments. So that's kind of where we're at with these rates. So I thought that as the Fed raises rates, that would have an impact on the economy, making it more difficult for corporations to pay their debt, which would then create layoffs, which then would cause rates to come down. Because when the economy is struggling a bit, then more investors flock to bonds, they buy more bonds, and that keeps long-term mortgage rates down. So to summarize that, the reason I thought rates wouldn't go up too high is that fundamentally, even though the economy looks like it's booming, so much of it is based on debt, and debt is so sensitive to interest rates. And when the economy, so when there's any kind of nervousness, investors then buy those bonds, which is then more tied to those mortgage rates. So was I right? I was right. The 30-year fixed rate mortgage did get really close to 5% and then softened a little bit just in the last few weeks. And that is because of all this volatility. And again, investors don't like volatility at all. And they're like little scared chickens running around with their heads cut off. Whenever anything happens, anything fearful, then they flock to bonds. And then again, that lowers interest rates. So even though we see the Fed fund rate going up last week, we didn't see the mortgage rates going up. And that's very confusing to a lot of people. But that's why when people see the Fed raising rates, when savvy investors see that, they get nervous because that could trigger a recession. And in most recessions in the past, that has been the element that has triggered the recession, because it's not like the Fed is trying to create a recession. They're trying to create a slowdown, but they don't necessarily, do it slow enough, or they do it too, they raise the rates too many times too quickly. And basically, there's a lot of economists that will say there's never a soft landing. If there's bubbles, they pop. So that is why investors get really nervous whenever the Fed raises rates, just waiting to see if the shoe will drop. So that's why I think in January we're going to see more home sales, in my opinion, unless we have a really cold winter, because we've seen lower rates over the last couple weeks. So if people were kind of holding off, hoping for that, they had this window of opportunity to go buy that house that they were hoping to buy. All right, so on home prices, I thought that they would increase, around 5%, 6% or so nationwide. I mean, gosh, every area is different. So what did it end up being? About 3.8% from October, from last year to this year. Now, we don't have final numbers for the end of the year, but this last existing home sales numbers that came out yesterday was closer to 4.2%. So it was kind of close. Basically, the median existing home price nationwide for all housing types was about 4.2%. So that's pretty close to 5%. I would say, there weren't any declines, and that's a good thing. Tax reform. Now, last year, I was on a lot of radio and TV shows with reporters asking if I thought that the tax reform would affect California home buyers, because you have a reduced mortgage deduction. Instead of being able to write off $1 million mortgage, it's deducted to $750,000 for new buyers. And then, of course, the SALT deductions affect homeowners in high-priced markets. They don't get as big a deduction. So many people, so many newscasters asked me if I thought it would slow down sales in California. And I said, I've been living in California my whole life, born and raised here, and I don't know too many people in the $1 million market, because we're talking about mortgages of $750,000 and up that would be affected for the most part. And I don't know too many people buying that $1 million house that are really aware of the kind of tax savings they're going to get. I mean, they know they're going to get a deduction, but they're buying because they want the house, they want the neighborhood, they want their kids in that school district. And if you're going to buy $1 million house, you're just not counting pennies generally. So I didn't think it would really affect the market, and I was right. So you look at the San Francisco market, and we keep seeing home prices go up, and the same for LA, where it didn't seem to affect it. So that's interesting to see that I was right. And that's even with so many Chinese buyers pulling out of the market, to see that California home prices stayed fairly steady over this past year without the great deductions, without, with reduced tax benefits is interesting. But again, I kind of expected it because there is such low supply on the market. And there's just so many people still wanting to live in these areas where there's tremendous job growth in San Francisco and LA that, if they can even find a house around $1 million, they're going to buy it because it might even be cheaper than rent in some of those areas. Probably not. But anyway, I didn't think it would affect it, and it didn't. But what I did think is that Detroit there were certain metro areas that would outperform others simply because they were already undervalued, incredibly undervalued. And Detroit was one of those. I don't know if any of you on the webinar today got to go to our Detroit event in, I believe it was May. We took about 150 people out there, did a great event, and then did a tour of the area because I was just so bullish on what's happening into that city. It's really becoming world class again, just beautiful with so much redevelopment. There's still a long way to go, but they've come a long way too. And it's still so ridiculously affordable. And again, I was right there. The average sales price in Detroit jumped 13%. So definitely outpaced the rest of the country. Certain suburbs appreciated a little bit more slowly in Detroit. But what I would always tell people is when I buy an investment property, I want both. I want cash flow and I want appreciation because I'm born and raised in California and I got to have my appreciation. It's just cash flow alone is a little boring to me. So when I find a place like Detroit that is really it's coming from its lowest low. I mean, it probably hit its lowest low in 2012, 13 or so, or when it went bankrupt. Then after that, let go of so much debt, and then all these billionaires came in and started revitalizing the city. But you could still buy houses for $20,000, $30,000 and, put $20,000, $30,000 in renovations and have a fully renovated house for $60,000 that rents for $800 or $900. I mean, those are the numbers I like, especially if that $60,000 house I bought is going to be a $120,000 house in a few years. Then we've got a deal. And that's what I like. So that is exactly what a lot of our investors did, and they bought there. And hopefully are happy they did because we have seen those price gains there. Okay, so here's Dallas. Now, one of the reasons why I was concerned about investing in Dallas, even though so many people are flooding there to buy, is that it has increased in value so much. Now, when we were helping people buy in Dallas, it was right around here, 2004 to 2006 or so, right in here is when I was really encouraging people to sell their high-priced property in California. I mean, that the prices were way, way, way up here. So you could sell a house in Stockton, California for $400,000 and buy 3 houses in Texas brand new and get the same rent on each one, so you could triple or quadruple your cash flow. And prices were just below what seemed normal. How does it make sense to buy a brand new house for $120,000 near the city where there's the strongest job growth in the country? It just the numbers didn't make sense. I couldn't understand why the whole world wasn't gobbling these up. So we were, and you can see there was a bit of a decline over the recession, but not much. I mean, if you bought, definitely not in the neighborhoods we bought, there was no decline. But in overall in Dallas, there's a little bit, but not bad. And then all of a sudden you just see after 2012, it just takes off. The market takes off because there's so much job growth, and then starts to stall. And that was my prediction, was that home prices in Dallas would stall this year. So I was accurate on that as well. And so it's not that we don't still like Dallas. And Dallas, some people, that's where they want to be. They want to be where the jobs are. And I understand you're just going to be paying more and you're going to be getting less cash flow than you would have 10 years ago. But it's still a great market, but I just didn't think it would be an appreciation market this year. And I was right on that. So if you buy in Dallas, it's for security. It's to be where there's, so much in-migration, and probably you won't see a recession in Dallas would be my guess. So for protection and security, it's a great market, but I don't know that we're going to see appreciation there for a little while, because it just has to adjust to all this change and all these price gains. So, and then Houston, I had predicted that Houston would be a pretty hot market because of the, certainly because of the floods, and so many homes were taken out and it would take years to build them back. And sure enough, it hit all-time high in home sales and prices up. So that was a good market to be in. Similar to parts of California where there have been lots of fires, you're gonna definitely find some deals. I mean, you're not going to find deals. Prices are going to be high, but you'll see huge demand. The difference is that at Houston, it's cheaper to buy in and buy a house that's so desperately needed than say in Malibu, where there's 600 houses gone. But to go in and try to buy a property and as an investment property, it's going to be expensive. Oil prices. Now, we have a lot of investors who invested in North Dakota because it was such a booming market up until 2014, where there was, people were sleeping in their cars and they were commuting hours to get to their jobs, and they were staying in tents, and there was just massive demand. And then, of course, there was a crash, and then people were asking me, should we sell our house? Should we hold? And I said, well, never, you don't, if it's possible, don't sell right after prices have dropped, because then you're buying high and selling low, and that's no fun. Might be better to ride it out. And then after hearing some oil experts speak, they thought that oil prices would rise in 2018. So I went along with them and said, I agree. A lot of my predictions come from my conversations and interviews with economists who really studied this stuff and really understand it, and I just kind of compile the data and choose which economists I believe in, or just a blend of it. So it kind of made sense to me that the oil industry was maybe somewhat like the housing industry, where the market crashes and then you don't have any more investors coming in, or you don't have any more development, but you still have demand. You've got the U.S. population growing with, I think, 25 more million people than there were last decade. So 25 million more people needing oil, and of course the U.S., the world population growing, and the U.S. being a big producer of it now. It just seemed that eventually, just like in the housing market, builders stopped building, and even though we had just a flood of inventory in 2010, fast forward 7 years and there's no inventory because builders stopped building, but demand kept growing. But I thought it would be the same with oil, that all these rigs got shut down, but demand is still there. It's going to take a lot to get these rigs up and running again. And now it was just a matter of OPEC, manipulating things again, which they did. So again, I thought oil prices would rise and that people should maybe hold their property in North Dakota for that, if the numbers made sense, and they did, because the cash flow was already so good that a little bit of rent decline, even 50% decline, still covered costs for most people. And yes, we did see over the last year prices go up in oil. So that just kind of leaves us to what's next. These opportunity zones it's part of what was slipped into the tax bill, and it really hasn't been finalized yet. Will probably be finalized in January, the details of how to do it. But this, I knew this was going to be one of the most exciting opportunities, but we couldn't jump in because we didn't have the law, defining exactly how to go about it. But we were getting prepared for it. But I knew that this would, and predicted that this would be a big deal. And I was right there, because now it's the end of the year and everybody's talking about it. It is the next biggest thing. Now we've got President Trump, investing even more into it, because this could be the solution to our affordable housing crisis. That if investors stop building more high rises and downtown Chicago, I think there's like 76 of them going up right now or something, in New York, and all this investor dollars going into already developed nice areas. What if some of that money went into areas that needed development, in areas where it's more, where it's possible to provide affordable housing? And if we went in and were able to improve these areas and be able to buy land for cheap and get massive tax benefits for providing affordable housing, that that would be a solution. And that is where we are today. So at Real Wealth Network, we're going to be all over this next year. We already have 3 opportunity zone funds that we've got started that we can't wait to share with you at our January event. Our January event is January 12th in San Francisco and January 13th in LA. I think I got those dates right. So do check that out. It sells out. This is our biggest event of the year, because I'll be giving my 2019 predictions and what I see as the greatest opportunities. and some of the things that we'll be doing in these opportunity zones, I'll be sharing in January. It includes apartments and a single family fund and like all kind of good things. I'll be able to share that in January. And Rich will be doing his annual focused investor presentation, which is whether you're an investor or just wanting to have the most successful year of your life yet. He has wonderful techniques to help with that, and people love his session. So that will be January 12th in San Mateo and the 13th in LA. And then we have an event. We have our East Coast event where we bring all of our teams, all of them, to Tampa. Save the date for that to be in Tampa if you want to meet all of the teams who offer single family rentals. You can kind of do your all in one stop shopping. If you have a big 1031 exchange or something and you want to meet all the teams, then that, and also just our chance to get to meet our East Coast members and people who just have a hard time getting out to our West Coast events. That will be the first weekend in February. So save the date for that. We'll be talking about opportunity zones then as well. So I'm going to go to questions. Okay, this is a really long one. Somebody says last week on a podcast, it said that 78 million baby boomers will be reaching their late 70s and possibly unloading their homes and downsizing. How will this affect the housing market? That metric, along with some of the other convincing arguments from Peter Schiff, says that there would be a recession, makes me jittery as a new investor. Okay, so that is definitely something to pay attention to, that baby boomers will be getting old, but they're not that old right now. So I don't think the baby boomer problem is going to kind of come into play for about a decade, because I'm a baby boomer and nothing's changing in my life. I'm not, downsizing or anything. And the baby boomers ahead of me are 20 years older. So, I don't know, in their early 70s. And they're feeling good these days. I mean, people are healthier than ever. So again, I don't think we're going to see any big shift for about 10 years. But it's in 10 years that we're going to see the largest generation today be at the home buying age. So again, if you invest in property that is something a first-time home buyer could afford. So at Real Wealth Network, we only stick with affordable housing, which would be affordable. That doesn't mean government assisted living. It means, the average person can afford the average home in the area. And the way that you look that up is if the average income is $40,000, then the average home price should be around $120,000. That's how you know you're in a well-balanced market. So if you stay within that range, then in about 10 years, when these young millennials that are, the largest of them are around 25, 26, they're not looking to settle down. I sure wasn't at that age. But when they do, it's usually 31 is the time that they buy their first home. But the millennials are a little bit delayed, so it'll probably be a little bit, 32, 33 when they start buying, although many are still. They have to get rid of that student debt first. So will they be able to take the place of the homes that the baby boomers are leaving? And it's kind of a mixed bag. I think it will balance out because so many homes are sitting vacant as Airbnb rentals. I'm sitting in one right now, actually. I had to do this webinar, and I was also looking at Airbnb, so they don't know that I'm sitting in the Airbnb. Anyway, that's funny. So I think because of the massive amount of Airbnbs and people having a different kind of lifestyle, I really don't think that's going to be an issue. If anything, we have a terrible need for affordable housing. If you could buy anything for less than the cost to build, it's probably going to increase in value if it's in a quality area and near jobs, because there's just no way a builder can build affordable housing these days. It's very difficult unless you build a bunch of tiny homes, which not everybody's going to want to live in. But until somebody gets really creative, it's very difficult to build affordable housing. So stay away from the high end. There is already too much of that being built. But when you get into anything under $200,000, I just don't know how there will always be demand for that, in my opinion. But just make sure that you're buying in areas where there's job growth and population growth and not people leaving. Let's see, the next one is, tell us more about opportunity zones and how one goes about investing in them. As I understand it, they're only offered through opportunity zone funds. Yeah, so we did 3. Let me see if I can, since you probably don't want to sit here and look at my page, I'm going to go on our website. There we go. So when you're on our website and you go to the Invest tab or the Learn tab, then you'll be able to see all the things, all of our recent webinars. And if you go on those recent webinars, you'll see 3 webinars we did on opportunity zones. There's far too much for me to explain to you here, but you do need to have a capital gain. You need to sell something like a stock or a business or real estate, and you could take just the gain, you don't have to take the principal, but just the gain, and invest it into an opportunity zone fund. And the fund is simply a company that's formed with a primary purpose of investing in opportunity zones. So you can open up your own opportunity zone fund if you get the right counsel on that, and our webinars explain how to do that. So you can do it on your own with one other partner or several partners, or you can invest in somebody else's fund. So it does have to be a fund, but you can start that fund. Now, if you're going to raise money from other people, if you're using other people's money, that falls into the securities world, and you need to make sure that you're doing that properly. So you have to file with the SEC. So if you're going to open up your own fund and raise money, make sure you follow the rules and do it right and get the right attorneys to help you and the right CPAs. But if you're going to invest in somebody else's fund, the most important thing to look for when doing that is track record, because it's going to be a train wreck. There's going to be a lot of people who jump into this business who know nothing about real estate. So be very cautious there. And I do hope you make it to our January event, because we will be talking more about that. But definitely look at the 3 webinars that we did with CPAs. What's my advice to investors in California flipping houses? Again, it depends on your market. Overall, hey, listen, if you're in California, go to Bruce Norris's event in January 26th, and he'll talk all about that. But his latest webinar says, be careful. Be careful. We had a good long run, and things are slowing down. So just don't get in over your skis, and don't take too long to renovate, and don't do massive renovations. And if there's always a chance that it's going to take longer to sell, because it is taking longer to sell, and rates are possibly going to continue to go up. So just be more cautious if you're flipping, because we already know that the market has slowed down. It's probably slowed down. You probably already noticed it. So will it pick back up again? I don't know, but just make sure that whatever you do, you protect yourself, so that if you have to do price reductions, you're not losing money, or if you're forced to rent it, you're not negative cash flow. Is it worth it to get the 10% tax benefit, or would it? You get capital gain taxes are 20% if you're, depending on your category. And by the way, California, this doesn't apply to California tax. They're going to tax you no matter what. This is just federal. So yeah, you have to look at that and say, is it worth it? I think that opportunity zone is best for people selling stock, because you can sell your stock and then you can invest the gain into real estate and cash flow, and then use that cash flow. You're going to have to pay your tax by 2026. But I think for stock market investors, the opportunity zones are the best deal. For if you're selling real estate, a 1031 might still be better, because you might be able to just never pay that tax, and and then when you die, your kids inherit it, and then the property's stepped up to market value, and they don't pay tax. But some people don't really want to just pass the property on to their kids. They want the money now. So in that case, some people are just selling their investment property and paying the tax. And if that's you, then definitely consider an opportunity zone fund. DSTs, we were going to do some DSTs, but the opportunity zone came up, and we're doing that instead because it's great. All right, I do need to wrap it up. Thank you all so much for joining me here. I'm sorry about the snafus there with technology. I have really sad news. My sister was diagnosed with stage 4 cancer, so I'm going to be spending a lot of time with her, and that's why I'm getting this Airbnb. So that's why I've been distracted and had a little trouble here, but I would appreciate your prayers for her, and I know that she's responding really well to that. All right, thank you, everybody. Have a wonderful, wonderful rest of your day, and we will talk to you soon. Bye-bye.